Inflation, taxes, market crashes. It feels like your retirement is under attack from every direction. But what if you could build layers of protection around your wealth so that no matter what happens in the world, your lifestyle, your legacy is always secure? Today, we're going to break down the retirement shield strategy on the next Leibel on Fire.
Welcome to Leibel on Fire with Amazon best-selling author and Yields for You portfolio manager, Leibel Sternbach. Leibel on Fire is supported by our ETFs, Yields for You Strategy A, and Relative Strength Managed Volatility. Our mission is to help 1 million people retire with financial security. Now, the Financial Independence and Retirement Show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. It's Leibel on Fire.
Hello and welcome back to Leibel on Fire. I'm Freddie Bell, and I'm really pleased to be joined by Amazon's best-selling author of the book Authenticity. Leibel Sternbach is back with us. Hello and welcome, sir.
Hey, how are you today?
I'm doing well, and I'm getting better. And we talked about in the open layers of protection in retirement. What does that mean? I don't think I've heard you talk about layers of protection before.
Yeah, so layers of protection is a concept that we feel is very fundamental in everything we do, right? Fundamentally, we don't know what the future is going to hold, right? If we knew what the future is going to hold, we would all make a lot more money. And we would be a lot happier. But layers of protection, the concept is because we don't know what the future will hold, we need to plan for all eventual outcomes, right? So we need to build layers of protection in our plan so that no matter what happens, we're protected, whether the market goes up or down, whether taxes go up or down, inflation goes up or down, whatever it is, right? We need to make sure that we have a plan in place and so that we are protected. And that means knowing what are the things that could potentially derail our financial security and the financial security of our loved ones. What are the things that we're looking out for in the world that will tell us, hey, we need to switch tactics, right? This thing that was a potential threat, it's now a threat, right? Tariffs are going to impact us. Inflation has been too high for too long, right? That means not tomorrow that we're going to run out of money, but maybe in 10 years, we're going to be struggling. And so we need to make sure we're investing more aggressively, or that we need to make sure that we conserve as much money as possible over the next few years to counteract that, right? And so it's very important that we have these layers of protection built into our plan so that no matter what life throws our way, we are protected.
So how does this change the game when we're talking about market volatility? So, for example, if the idea is that near-term money gets protected and conservative investments are there for the long term, how does that work together?
Yeah. So the one of the biggest ways that we build layers of protection into your plan, right? You've got the planning side of things, right? So what happens if inflation? What happens, if there's war in the Middle East, right? What happens if the cost of oil goes up, right? That kind of things. But then you also have things, how do we protect our money? We know we're going to be spending money. We know that we're going to, we know that statistically the market corrects, on a regular basis. We know that we're going to experience this. How do we make sure that when we experience that, it doesn't change our lifestyle, right? How do we make sure that if another 2008 were to happen or another dot-com boom, right? What happens when that happens? How do we make sure that it doesn't completely, that we don't have to go back to work for 10 years, especially if now we're, 75 and going back to work is not really an option.
Right.
So how do we build that into our plan? And the biggest way that we build that protection into your plan is with something that we like to call time diversification. And so if you're familiar with asset diversification, right, you buy stocks and your bonds and you mix them together so that you don't have pure risk in the market, you don't have pure risk in the bond market, right? And hopefully you get a steadier ride. Well, time diversification kind of takes that same concept and applies it to time. So just like we invest our money into different asset classes, we're going to invest it into different time horizons. We're going to have a bucket for the money that we're living on for the next few years. And then we're going to have the bucket that we're going to use to replenish that money, right? So what happens if the market is down for more than a year or two? It can happen, right? Well, that's what that second bucket is for. We're going to take on more risk in that bucket than the first bucket, but still, If the market is down for more than the money that we have in that bucket, which typically we have another 2 to 3 years in that bucket, which after 2000, right? After 2008, it did, right? It took a few years to recover. So we have that money, right? If we have to deplete it and the market is down, we will not have a catastrophic loss. And what this does is it really creates a shield for our long-term bucket. That long-term bucket now can really afford to grow, right? Instead of us having to take all our money out of the market and put it into something like a fixed index annuity or into CDs, right? Where we're not really making a great return, but we've got stability. Now we get to say, okay, well, we're going to take a portion of our money, right? And we have a plan for it that's going to allow us to weather the storms of the market so that our money can, right? A decent portion of our money can be invested in the market for the long run. And that is what's going to allow us to participate in that market recovery. That's what's going to allow us to grow faster than inflation. Because no matter what happens, right? The stock market, and really the United States stock market is the greatest wealth building engine in the world. It is the greatest hedge against poverty. It is the greatest hedge against inflation, and we need to participate in it. We need to just participate in a way that is okay and doesn't endanger our financial security. And so using time diversification, using these buckets of money and investing them accordingly, this is why we have the ETFs that we have for these different buckets. That's what allows us to really enjoy our retirement and not worry about what's happening in the market.
So this helps me to sleep at night. I don't have to keep my hand on the wheel. It kind of sounds like you're putting me on offense. I'm thinking about football. It puts me on offense, right?
Yep, it allows you to stop playing defense and play offense, right? And because you have a really great defensive strategy that's working for you, right? Which, using that football analogy, right? That's the only way it works, right? If you don't have a good defense, then offense doesn't really matter. So
I've seen that happen with a lot of teams. So I think I see where this is going. So if my short-term income is protected, Leibel, I don't have to panic myself when the market drops. Is that what you're saying?
Yeah, not only do you not panic when the market drops, but it doesn't change your lifestyle, right? You're not worried about, oh, what does this inflation mean? What does the fact that Social Security is not keeping up with my increased cost of living, right? You're not worried about that because you got a plan. You know that when the market drops, oh, well, my investments are going to profit from that, and I can afford to wait for that recovery. Not only that, but it kind of builds in some dry powder for you. So if you're like, hey, listen, I think this market correction is way overblown. Let me buy in at this bottom. You've got some money sitting on the sidelines that are kind of lower risk that you can do that with. So it gives you breathing room, it gives you opportunities, and it really transforms your experience.
Give me a short primer. So is this when the Roth conversion can benefit me? And for those who don't understand Roth conversion, can you give us a short primer and show how that works with this scenario you just painted?
Yeah, absolutely. So with the time diversification, right, we know that we've got 2 to 3 years of expenses kind of just sitting on the sidelines, right? It's we've got our YFYA ETF, and we've got other strategies that we use for clients that we manage, and that is designed, right? It's designed to get that 5-6% a year in interest with very little volatility. It's not no volatility, but it's, a little volatility. So if the market goes down, let's say we have a 2008 correction, goes down 50%, hopefully that will not go down more than a few percent, right? That is the goal. So that if we have to even take out all that money and wait 3 years for the recovery, that's okay. It's not going to be a catastrophic loss that's going to cause us problems in 10 years from now. What that means, though, is, hey, market goes down, right? Like we've got this AI bubble going on right now, and people, 6 months ago, people were not saying AI bubble. Now they're talking about an AI bubble, right? And the market's being really volatile and reactive. Well, what happens when it eventually corrects, right? Because we're now 3 years into kind of a bull market, 3 years of consecutive double-digit growth, which is unheard of. When it does correct, and it's not if, it's when it does correct, will you have money on the sidelines to either convert and pay the taxes on that conversion, or will you have money to buy at a discount and participate in that upside, right? And that is what these buckets allow you to do. It has money sitting there in lower risk strategies. So market goes down 20, 30%, it's going to go down, 5, 6% maybe, right? And now you have this money and it's relatively stable and you can say, well, I want to double down on the growth, right? Let me get more growth, or let me convert more of my growth money and do that Roth conversion, because now I've got a discount on that money. That money's down 20, 30%. I'm going to convert it. I'm going to use my lower risk money to pay the taxes because I have money to pay taxes, right? Because that's the double-edged sword of Roth conversions. Yeah, great. You got the timing, but where are you paying the taxes from?
It makes a lot of sense. And we're talking about the retirement shield strategy and layered protection. It seems so simple, Leibel. Why don't more people or more advisors use this?
So it sounds simple on the surface. The challenge is implementation, right? And that's the challenge with everything, right? So advisors kind of fall into two camps. There's the advisors who sell products. And so they're primarily transactional. So they're going to sell you a strategy, but that strategy is really going to be something like a fixed index annuity and maybe an investment strategy in disguise. And they kind of wipe their hands of you, right? You come in, you get all the stuff up front, and then they wipe their hands of you because now you're cookie cutter and they're going to go on and, kill the next horse. The other type of advisor is the very hands-on person, and that hands-on person is doing a lot of work. Well, with the hands-on person, they're probably implementing something like this, but not a lot of advisors want to take the time because it's very expensive and it's very time-consuming to do this properly, right? When do you replenish these buckets? We didn't talk about that, but timing when you replenish these buckets is really important, because if you replenish at the wrong time, right, then you're no different than taking money out of the market at the wrong time. And so you've got a certain timing aspect of, you want to harvest gains, in this case, to replenish the buckets, which means, again, you're looking at those market highs and you're saying, okay, let me trim some of that fat and let's replenish these buckets and bring things back into tolerance. That requires a lot of supervision. That requires a lot of having your finger on the pulse and doing it for a lot of clients. It is not something that you can have, 1,000 clients and be doing this for. You got to know every single person in this situation to be able to do that. And so implementation is the primary reason why people don't implement this. And this is also why I'm CTO of a fintech firm, right? I have built the technology to be able to do this, and not a lot of advisors have access to it. I do work with a group of advisors who implement these strategies and who I help them implement it, but it's a small community.
Real small community. Really quickly, why did you decide to take this strategy when there could have been an easier path for you?
So all the easier paths, right, is they do not provide the ideal outcome for clients, right? So yeah, the easy path is, let's just hand our money over to an insurance company and let them worry about it. Or let's just, do a 60-40 portfolio and be like, oh, well, statistically it's okay and we'll be okay. But the fact is, and this is what I saw as being an advisor who supported advisors over the last, 15 years, I saw where all of those things failed, right? All of the advisors who were like, I'm going to outsource the worry to somebody else, and I'm going to just do what the textbook says to do. Well, it fails, right? The textbooks were written 20 years ago, and the market's been different for the last 20 years. So you really got to do the hard work, and there's no, you got to do the hard work in order to get this right. And that's why we do what we do. For a lot of people, right, they're okay with simpler strategies, right? And you do your 3 buckets. Once a year, you rebalance and you're good. But you need to know what those 3 buckets are and how they should be invested. And for people who have Roth conversion or tax loss harvesting or any of these timing issues, you just gotta do the hard work. There's no two ways about it. And that's why I started Yields for You, because I didn't see people doing the hard work.
So when listeners and viewers go to yieldsforyou.com, what should we be looking for?
So on yieldsforyou.com, we got a lot of resources for you. We've got a 60-second retirement builder planner that you go through, answer some basic questions. And it is kind of like an automated version of what we will do for you for free as part of our retirement tax SWOT analysis, but it'll give you an idea, kind of a big picture. But hey, do you have things that are worrying some or that need a lot of attention in your plan? Or are you good with, you've got a lot of safety margin of error built into your plan that you're okay with, kind of, it doesn't really matter when you do that Roth conversion timing because you've got a lot of room in it. And you can't screw that up too badly. So you'll get that sense from that 60-second plan. And then again, really, right, there's only so much a computer can do, right? You need an advisor, you need a team of people who have seen it in different markets and go, well, although the computer says this, or the numbers say this is something you should be worried about because of your personal situation, something that doesn't come out in the numbers, but is something that, you discussed with us in that intake process or in that planning process. Because no two people are alike, right? I've done hundreds of analysis and I've yet to be able to predict ahead of time what the recommendation will be beforehand because everyone is so unique.
Makes a lot of sense. The website is Yields for You, yields, the number 4, the letter U.com. Leibel, thank you so much. And that's all the time we have for today. But join us again next time when we talk about and we reveal the strategic Roth conversion playbook and how to turn your retirement accounts into a tax-free legacy for the next generation. This has been Leibel on Fire, and I'm Freddie Bell.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yieldsforyou.com or call 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.